All right, Warner Brothers Discovery, a trending ticker today on Yahoo Finance today after receiving some love from Wall Street. Bank of America adding the stock to its US 1 list, saying the media giant has, quote, long-term potential. Also, Goldman calling WBD its favorite media stock. Joining us now with more on this is Yahoo Finance's Allie Canal. Allie, why is it their favorite stock?
I mean, this is crazy. The stock closed more than 8% higher today. Since December 28th, the stock is on a tear, up 30%. And this is after a pretty disastrous 2022. But there's a few reasons why both Bank of America and Goldman have this increased optimism around this company. Number one being the fact that we've reached several merger milestones, and that should ease some of those profit pressures. We will also have the streaming relaunch in the spring, reportedly called Max, and that should be a big driver when it comes to Warner Brothers Discovery's direct-to-consumer division. But if we go back to 2022, the stock lost close to 60% in the year, and that was amid various restructuring charges, macroeconomic challenges, further subscriber losses in linear television, and a slowdown in advertising. Bank of America did say in their note that advertising will likely pressure earnings when we get those results next month from WBD. But for now, investors seem pretty confident in the future, at least in 2023. And I think it's this improving narrative that's leading to the stock price today.
Allie, let's also talk about Disney since we have you here on set getting some attention. Guggenheim was out with a new note today making some revisions just in terms of their expectations for the current quarter and also the international launch of Disney Plus, the ad tier there, right?
Yes, and they're saying that is not going to happen until 2024. Another key update here from Guggenheim is that the disappointing performance of Strange World, that was that animated movie from Disney, and we really haven't seen that big Moana or Frozen type of film in quite some time for this company, but that was a huge disappointment. It only earned about $70 million in domestic ticket sales, about half of its reported production costs, so it actually lost money, and that will likely impact the company's bottom line and earnings per share once Disney does report its first quarter earnings results next month. That's according to Guggenheim. But on a positive note, the parks business seems to be thriving. The bank said it anticipates domestic park attendance to see a growth rate of 13%, and that's supported by increased travel at TSA checkpoints, along with more downloads of the Parks Experience app. And that's also despite these recent price hikes, this potential pullback in consumer spending amid a recession. People are still going to the parks. They're still spending money. The parks just continues to be this lifeline for Disney, and that's going to help them as losses accelerate in DTC. So a lot to look forward to in that earnings report.
Yeah, it's really amazing that consumers are still spending and traveling and going to places like Disney, given the cost of it and the fact that we have this looming recession, people clearly changing how they are spending. But the one thing that they remain to be spending on are those experiences, and clearly Disney a benefit there.
Huge benefit.
All right, Allie, thanks so much.